Here's a question most people never think to ask their CPA. What if I just didn't pay that tax this year? Not skip it, not cheat, just legally push it out. Because here's the thing, a dollar you defer isn't a dollar you lose. It's a dollar that keeps working for you. And depending on how long you defer it and what happens to tax rates in the meantime, you might end up paying a lot less than you would have today, or in some cases, nothing at all. That's the first D, and it's more powerful than most people give it credit for. Deferring. Welcome back. I'm David Blain with BlueSky Wealth Advisors, and this is the first video in our series of the 5 Ds of tax planning. If you haven't watched the intro video yet, I'd recommend starting there. It sets up the whole philosophy and explains why the order of these Ds actually matters. But if you're jumping in here, here's the quick version. Most people think about taxes backwards. They focus on the deductions, and deductions do matter, but that's the last thing sophisticated planners think about, not the first. The first question is always, can we defer this? So what does deferral actually mean? It's very simple. You legally push the recognition event into the future. You still owe the tax, but just not today. And that distinction matters for two big reasons. First, what we call the time value of money. The money that you would have sent into the IRS today stays in your pocket. It keeps compounding, it keeps working, and that adds up fast, especially on large sums. Second, what we call rate optionality. Tax rates change, life changes. You might be in a lower bracket in 5 years. You might move to a state with no income tax. You might pass assets to heirs with a stepped up basis, meaning the gain disappears entirely at death. Or, and this is a real home run, you might qualify for a structure where the deferral gain is eventually excluded. Not just deferred, but gone. Now, rates can go up, so you got to be careful for that. But generally speaking, this is a great strategy. This is not theory. It's available right now in the tax code, and we'll get into the details here in a minute. Say you have $1 million gain. Maybe you sold a business, you sold some real estate, had a big investment year. It doesn't really matter. The point is you've got $1 million taxable gain sitting in front of you that you got to pay tax on. If you pay the tax today, let's assume your federal and state rate is about 28%, and you're writing a check for about $280,000. The money's gone, it's done. The IRS gets it, and it stops compounding for you forever. Now, what if you could defer that $280,000 for 10 years, let's say? At a 7% average rate of return, that $280,000 grows to almost $550,000. You still owe the tax eventually, but you keep $270,000 in growth you otherwise would never have had. Same tax bill, completely different outcome because of the timing. Defer. And again, in some structures, you don't pay tax in the end at all. But even without that, the math on deferral is compelling. So let's talk about how deferral actually works in practice. I'll group these into 3 buckets. Bucket 1 is retirement accounts. And I know everyone's already heard this one, 401k, IRA, SEP, defined benefit plan, etc. These feel basic, but here's the framing that most people miss. A retirement plan isn't a savings account with a tax benefit. It's the tax deferral machine that also happens to hold your retirement savings. Every dollar you put in this is a dollar that doesn't get taxed this year, and it grows tax deferred. And you control to some degree when you pull it out and what bracket you pay tax at. For business owners especially, a well-designed defined benefit plan can shelter a significant amount of income every year. I mean, we're talking hundreds of thousands of dollars in some cases. Even if you don't need retirement savings, it's a great tax deferral vehicle. Now, you might be wondering where the Roth IRA fits in this. And here's the thing, it doesn't fit in here. A Roth is actually the opposite of deferral. You're paying the tax today on purpose, and the idea that you pay at today's rate so that everything that grows from here is tax-free forever. And that's obviously not a timing play specifically because you're never going to pay the tax in the future. You're changing the nature of the income tax today to tax-free. And so really in our framework, that belongs in what I call D number 3, which is displace. And so we're going to cover that in detail in another video. But I mention it here because people always lump Roth in with retirement accounts and assume it's all the same bucket, and it's not. And understanding the distinction is exactly the kind of thinking that this series is built to develop. Retirement accounts are not the same thing. Bucket two, I want to talk about transaction structuring. This one's big for business owners and real estate investors. If you're selling a business or a piece of real estate, you don't have to take all the proceeds in one year. An installment sale under what's called Section 453 lets you spread the payments and the tax over multiple years. So instead of recognizing, say, a $5 million gain in one year, you might recognize $1 million a year for 5 years. It could keep you in a lower bracket. It certainly smooth out your tax bill. It gives you flexibility and you get that deferral. For real estate specifically, you've got the magic of the 1031 exchange, which lets you swap one investment property for another of like kind and defer the gain indefinitely. Properly executed, you can keep rolling forward gains forever. Some people do this their entire investment careers, like myself, and the tax bill never comes due because the basis it will eventually step up at death. And for executives and business owners who receive deferred compensation, what we call non-qualified deferred compensation arrangements, this is another way to push current year income into future years when your tax situation might look different. You may retire to a different state or something like that. Bucket three is investment structures. And these are some things people maybe have never heard of. One I'll highlight here is QSBS Section 1202 applies to certain qualified small business stock. If you hold the right kind of C Corp stock for 5 years, up to 100% of the gain is excluded from federal tax. It's not deferred, it's eliminated entirely. But like a lot of these strategies, the seed of that benefit has to be planted at the structure level before the gain ever happens, which is the whole point of this series, is plan first and never be in a reactive mode. All right, so here's one I want to make sure you don't miss. What I call a wait, what moment? Qualified opportunity zones. Most people have vaguely heard of this program, but let me explain exactly what it does and what has just changed, because the timing here really matters a lot. So the original program was created back in 2017. The concept was very simple. If you had a capital gain from a business, real estate, stocks, like anything, you had 180 days to roll that gain into what's called a qualified opportunity zone fund. When you did that, the tax on your original gain was deferred. And if you held the investment for at least 10 years, all the growth inside that opportunity fund was completely tax-free, not deferred, but eliminated. So you had two benefits stacked on top of each other. Now here's the catch with the old program. All that deferred tax comes due on December 31, 2026. Judgment Day, if you will. If you invested under the original rules, that bill is coming due this year, 2026, regardless. So for anyone thinking about jumping into the old qualified opportunity zone right now, the deferral benefit is essentially gone. You'd be referring to a date that's really already here. But here's what's changed everything. Congress just made the program permanent under what's called the One Big Beautiful Bill Act. And so starting January 1, 2027, there's a brand new round of qualified opportunity zone investments with updated rules. New zones, new designations, and a rolling 5-year deferral, meaning the tax isn't due at some fixed future date. It's due 5 years after you invest. And here's what people may not realize. After holding for 5 years, you get a 10% step up in basis on the original deferred gain. That means 10% of what you originally deferred, what you would have owed, just disappears. You'll never pay tax on it. Hold it for that 10 years, and all the growth inside the fund is completely tax-free. So you're stacking three benefits: deferral, partial exclusion of the original gain, and full exclusion of the growth. Here's another neat little thing. If the investment is in a rural qualified opportunity zone, that 10% step up at 5 years becomes 30%. So 30% of your original deferred gain is gone, wiped out completely. So that's a significant number on a large gain, and it's a new feature of the 2027 program, specifically designed to push capital into rural communities. So if you have a gain in 2026 or beyond, The window you want to target is 2027 and after. That's when the real benefit kicks in. So make sure you're ready when that window opens. States are designating these opportunity zones right now. Now, here's the second, wait, what? Moment. And this one's specifically for anyone who owns a piece of a partnership or LLC tax as a partnership. So pay close attention. This is a really great benefit. When a partnership sells an asset and generates a gain, business, real estate, whatever, you might assume the 180-day clock starts the day the sale closes. Well, you could do it that way, but for partners, the 180-day window starts on the last day of the partnership tax year, which for most partnerships is December 31st, not the date of sale. And then there's an even greater option that's even more powerful. You can elect to start the 180-day clock from the partnership's tax return due date, not including extensions. So for a calendar year partnership, that's March 15th of the following year. No extension needed. It's just the statutory due date. So your 180-day window would be from March 15th all the way to September 12th, 2027. So let that sink in. Again, recognize, say in January of 26, the first business day of the year, you'd have potentially till September 12th, 2027 to invest in the fund. That's more than 20 months from the date of the gain. And because you're investing after January 1, 2027, these new rules, the rolling 5-year deferral, the 10-year growth exclusion, etc., the full package applies. This is not a loophole. It's exactly what the IRS regulation says. And most people, including a lot of CPAs, don't even know this. So if you own part of a partnership, make sure you ask specifically about this election for the 180-day window. It could be a very valuable question that you ask. And during that time, you can earn interest or do whatever you want with the money. So here's the practical takeaway. Before you write any big check to the IRS, before you accept that a tax bill just is what it is, ask this one question: is there a legal way to push this out? Preferably ask that question far in advance and ask, could we structure this differently? Could we spread this out over time? Is there an investment vehicle that would let us defer or even eliminate this gain? Most people never ask. And so the ones that do, or who have advisors like BlueSky who actually know the answer, they keep a lot more of what they earn. So deferral isn't about avoiding your obligations. It's about using the tools that Congress built into the tax code. Tools that are sitting right there and available to anyone who knows to look for them and understands how to utilize them to their benefit. So the next video up is D number 2, what we call divert. And this one is a completely different idea. Instead of pushing the tax to a future date, divert is about making sure someone else pays the tax or nobody does. Family members, trusts, charities, things like that. These are some really powerful tools in this bucket. So I will see you next time.